Hello and welcome to the Stansberry Investor Hour. I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Dan is on vacation this week, but the show will go on, and today we're talking with our colleague, Brett Eversole, Stansberry Research Senior Analyst. Brett's been with the company since 2010. He's the lead editor and analyst for TrueWealth Systems, and the free DailyWealth e-letter. As I think you'll see, he's a sharp, insightful guy, and I like to think of him as a descendant of Steve Sjuggerud. For those that know him, our Stansberry Research co-founder, you may hear some familiar wisdom from Brett. So here it is. I'm looking forward to having this chat with Brett, and let's get to it. All right, Brett, welcome back to the show. I know our subscribers and a lot of listeners are likely familiar with your name and your work, but for those who might not be, let's just kind of orient them briefly. Just kind of what your responsibilities are here at Stansberry.
Yeah, well, thank you, Corey. It's happy to be back. I always enjoy coming and chatting with you and Dan, although we threw Dan off this time, so probably have a more lively conversation if you ask me. But yeah, I've been with Stansberry Research for 15 years now, a long time. I write TrueWealth and TrueWealth Systems. And for long-time readers, they probably remember a guy named Steve Sjuggerud, who was one of the founding partners of Stansberry Research. Steve hired me back in 2010, and I've got a background in mathematics. So he kind of brought me in to develop and build kind of trading systems. And that turned into the product that is now called TrueWealth Systems. And I worked with him for a long time. And then when he stepped away a few years ago, I kind of stepped into those roles and have been, working on TrueWealth and TrueWealth Systems for a long, long time. And now they've kind of come under my wing. So it's been a lot of fun over the last few years.
Yeah, it's been interesting to watch you kind of take over. I think of you as like a direct descendant of Steve Sjuggerud, and it's nice to have somebody like be able to pass that on to and learn from him. I wasn't going to go here right off the bat, but what's like one or two things that stick out from working with Steve, maybe in your early days, like that you really like were eye openers for you?
Yeah. So, this isn't necessarily investment related, but one of the things that I found incredible about Steve, and this is very much a personality trait, is that anytime there's a door that's kind of just barely cracked open, he just kicks it open, wide open, and walks right through it. And what I mean by that is he goes out of his way to find people who are really, really good at whatever they do. That could be investing, that could be music, that could be surfing, a lot of his hobbies. And if he has any chance to open up a relationship with these people, he kicked the door down and opened up a relationship with those people. And so I got to ride shotgun with him throughout the years, doing that with a lot of different, in the investment world and then outside of it as well. And I think that's just a very unique personality trait that he has that allowed him to be a generalist in a lot of fields, but get very, very detailed, on the ground information from the right people whenever he needed it about whatever it was. So that's a kind of a personality thing that he did that I definitely can't do it the same way he did. He's a one in a million, I would say, at doing that, because obviously you can do that wrong and just make a lot of people angry or be like kind of overbearing and difficult. He always tried to give those people benefit right off the bat. Instead of asking them for something, he tried to deliver something to them. And then that's a great way to forge those relationships. But then the other thing I would say is it's kind of funny looking back, because I think I was able to take over TrueWealth and TrueWealth Systems off of Steve, I think relatively easily, because it's two things. Number one, he obviously kind of molded who I am as an investor. But at the same time, I've never met anyone in my almost 40 years of living who thinks more similarly to me than Steve. Somehow he and I, the way we come at problems, the way we diagnose problems, the way we think about kind of everything in the world is almost perfectly aligned. And it's almost to the point where it's bizarre, where even early on, we would start talking about a subject and we could just be like finishing each other's sentences, and we angle towards the same weird part of a thing to understand it and think about it and move forward through it. So I think in a lot of ways, it accidentally worked out perfectly, if that makes sense.
Yeah. So it wasn't hard to be convinced of cheap hated in an uptrend for you.
No, I mean, it kind of made sense right off the bat. And for me, it's not a question of does it make sense? It's a question of do the numbers bear it out? Because he and I both have a relatively mathematical mind, I would say. So what I've learned through 15 years in the world of investing is that people love to tell stories. Stories are really how you sell investments. Stories are what people get excited about. Stories are what people hold on to investments, whether they're going up or down. Um, and I've learned that stories can be important. You have to understand why a thing is happening. But at the end of the day, the numbers are the truth. Um, Stories can be fudged, stories can be lied, stories can be made up. But if you have something that has been kind of proven mathematically over a long period of time, there's no getting around that. Like the numbers and the fundamentals really are the truth over a long period of time. So again, the philosophy, like you said, that we use is cheap, hated, and in an uptrend. And this is kind of like it's a great philosophy for that generalist type idea because it's kind of holistic and all encompassing. So you look for things that are good value, cheap. Um, you obviously don't want to overpay if you can avoid it. You also want to buy things that other people are not excited about. So that's hated. You think about like housing in 2010 or gold at the bottom in 2016, 2017, or real estate over the last 2 years, I would say. These are things that people have absolutely no interest in. Generally speaking, when you find things that are hated, they're also inexpensive. And those are two really good kind of starting points. What Dan does in value investing probably has a lot to do with cheap and hated. The last part that we tack on, or that I tack on, is the uptrend. And so when you wait for prices to start moving higher, what that's done is it's the market telling you that all that research you've done is right. Because you can find things that are cheap and hated that have been that way for a year or 2 years or 5 years and that are maybe never going to recover to what they were in the past or what you hope they'll be in the future. But if prices start moving higher, that's the market telling you that, oh, yeah, there is something here and other people are starting to notice it. So you can just, by waiting for the trend to be in your favor, you just remove a lot of risk from the situation. Um, and what we always want to do as investors is try to find the most upside potential with the least amount of risk. So cheap hated uptrend is the way I get there. And I think it's something that you can really prove throughout history mathematically that works really well.
Yeah, and you guys and Steve and you and the whole team have done it for for a while and proven it. I remember when I first started at Stansberry, one of the earliest examples for me of that, seeing you guys do it, was when like after COVID, oil and
Mm.
energy. Um, I think you were some of the first people I saw to say buy energy. I think it was the end of 2021
That,
or was it 22?
that was probably in maybe August or September of
Yeah,
2020. And
yeah.
yeah, I
So
mean, it was a crazy situation, right? With oil prices going negative there, where people were having to pay to have their oil stored on barges because there were no capacity left
right, right,
with the
right.
global economy shut down. And it took a minute to get going, but yeah, I think we had some trades that were up 100 or 200% in 12 months or so
Yeah.
because it was a very unique kind of crazy situation.
Yeah, for sure. And maybe we can talk real estate a little bit later. I do want to ask you just because I have it on my mind, but let's maybe go till I was looking at the last time you were on here with me and Dan, March 2024.
Okay.
The title of the episode was "Boring Times Ahead Could Mean Fantastic Gains," and you said, "I do think stocks will do well through the rest of the year. I think the market's in a pretty healthy place." Of course, that was right, right? The S&P 500 ended up 25% last year.
Yeah, sounds about
Um,
right.
yeah, and that was leading into the election, presidential election. Now we, we had calmer times last year. Now is not boring at all. It's been anything but boring. Um, I guess what are your thoughts now about just what you're seeing from the indicators that you trust, just market in general?
Sure. Yeah, I mean, it's funny. I think your setup is completely right. And I think if we'd had this conversation even a month ago, definitely 2 months ago, I would have had a different outlook. But I think we're very quickly moving back into a boring market. And I think that that's already happened and people are they're not going to catch up to it for a few months, but I think it's already very much happened. Here's what I mean when I say that. I think a boring market is one that is driven by fundamentals. There are certain times, and we just lived through one, where you have a lot of headline risk. Maybe it's the pandemic coming on in March of 2020. Maybe it is the inflation going on in 2022, where every month after month, the next inflation print is going to determine what happens to the market, or not just over the next few days, but over the next few weeks. But then you get into markets where there's not really anything crazy going on, and then it's just the fundamentals that matter. Now, it might surprise people to hear me say that right now because of what's been going on with tariffs. But what I've seen happen over the past, the pandemic and the 2022 inflation are great examples of this. When you have something that's new and crazy and truly unexpected, I think we bill things as unexpected pretty often when they're actually not that unexpected. But when you have a truly unexpected event, markets react dramatically and quickly. That's exactly what we saw in April on the Liberation Day announcement, and then with tariffs being pulled off. And in the weeks and months since, there have been plenty of news on tariffs. And when you get the first piece of news, it's really jarring. When you get the second piece of news, it's pretty jarring. When you get the third, a little less and a little less. And when you're on to the 100th piece of tariff news, it stopped moving markets. We saw the threats over the weekend towards copper and towards Europe, and U.S. markets didn't move effectively.
Exactly. Yeah.
And so, I think we're to that point where, of course, if we actually went back to Liberation Day tariff levels, that would be a mess, and we'd have to figure that out. But I think the market doesn't believe that that's going to happen. And so I think what is going on is that we're moving back to fundamentals mattering. And at the end of the day, we had a really good first quarter of earnings. We're getting quickly back into earnings season for quarter two. And I think that it's going to be fundamentals that are going to drive things. And to me, that's a pretty bullish place to be. Goldman Sachs just came out and said that they expect the hyperscaler capital expenditures to be 1.15 trillion in 2025, 2026, and 2027. For those same companies, they spent around 480 billion over the 3 prior years. So what really, in a lot of ways, kind of saved the market in 23 and 24 was this AI rollout and this massive amount of capital spending from the largest corporations in America into the real economy. They are going to spend about twice as much over the next 3 years as they did over the past 3 years. To me, that's incredibly bullish for the U.S. economy. That's incredibly bullish for the U.S. stock market. It doesn't mean that every company is going to do well, but at the end of the day, 7 companies make up 35% of the S&P 500. And if they're spending like that and getting the returns that people expect out of it going forward, those companies are going to do incredibly well, and the overall market's going to do incredibly well. So I think we're going to see through Q2 earnings, stocks are going to trade based on those fundamentals. So I think we're moving back to that boring market. And I think the underlying pieces that are going to drive that market are incredibly bullish. So I kind of have the same, I guess the same thing to say I did last year is that, I think we're mostly past tariffs. I think there could be a big unexpected announcement, but I think that's pretty unlikely at this point. I think people have already moved past it, whether they realize it or not. Fundamentals are going to drive the market, and fundamentals are darn good.
Yeah. Wow. Okay. Yeah. It's a lot's happened between last time you were here and this time, but we're back to a nice boring place. Maybe I kind of feel similar. You saw in April, obviously that big drop in stocks, and then with each progressive move, as you said, I thought of again something Steve said and you've said is things were getting less bad. As each thing went along, each negotiation, and people can start to see what is actually happening here. And for example, like over the weekend, I think recently one of these letters that the White House sent out on tariffs, like one of the rates was actually higher than the reciprocal tariff rate from Liberation Day. And
in Europe, I think it was 30% instead of 20%, right?
Yeah, and you saw, like what you said, nothing, really too much happened negatively in the market. So interesting. So back to fundamentals, hyperscaler spending. It sounds like this was just a blip in the bull market, right? Or I guess we never technically got into a bear market in April.
Yeah, people like to argue about that. In my mind, if it's not negative 20, there's no rounding involved. I've
Okay.
argued with
All
people
right.
about this
Yeah.
about 1990. I think we're down 19.9% or something
Yeah.
if
It
you
was
want to call
pretty
it.
close. Yeah.
You got to draw your line somewhere, and once they're drawn, they're drawn.
Yeah. So we're back bullish. And another thing I know you've written about is a secular bull market versus
Mhm.
cyclical bull market, secular bear and bull, and secular. Maybe can we get back to that a little? That's something you've been
Sure.
talking about last year too. Are we still just in that? Is that just
Yeah.
where your head's at?
So a little bit of background on that. So we think of these, like we just talked about it, down. If we were down 21% instead of 19 in April, that would be a bear market. We call a negative 20% decline a bear market. But what we don't think about is that there are bear and bull markets in the shorter term, and then there are these much longer term cycles. So we call those secular bull markets. Those tend to last 15 to 20 years for bull markets, and 12 to 15 years for bear markets is what they've been over the last 100 years or so. So this current secular bull market we're in, we generally peg these when stocks break out to new highs. So it's not the 2009 bottom, it's in 2013 when we broke out to a new high. So from there, we would expect stocks to have a roughly 15 to 20-year bull market. So that puts us to 2028 or into the early 2030s, something like that. Now, what tends to happen when you study these throughout history, and I'll caveat it by saying we don't have a lot of these cycles. Maybe in 500 years, somebody will be doing this and they'll have a ton of cycles to look back on. But compared to all of history, the stock market's relatively new. So we have 100 years of data. What tends to happen is you get the secular bear market bottom at the end of like horrible economic times. So you think about the 70s being this terrible inflationary time. The economy was a mess in a ton of ways, and then you get this bottom in 1982. For about half of the secular bull market, you kind of have an economic recovery. Nothing crazy is going on, but things just stop getting bad and they start getting better. So throughout the 80s, you had a lot of financial booms happening, and the economy just generally slowly improved. Then in the 1990s, you got a real catalyst, and that was the internet. That turns into kind of a massive capital spending boom, and then that turns into a speculative bubble at the end. What's playing out right now, in my mind, is exactly the same. So the 2010s, as we came out of that secular bear market in the 2000s, was really just kind of like a return to normal. People complained about the slow growth, but growth was better than it had been over the prior 10 years. The economy was improving. The job market was strong. Corporate America was getting better at being, companies were getting better at being companies. And then you get to the early 23 or early 2020s, and now we have this AI catalyst. And so what I think is going to happen, and it's kind of playing out, it's almost in a lot of ways eerily similar to how the 1990s were playing out, in that what we have right now is this massive infrastructure build out. Like I said, those hyperscalers spent $500 billion. They're going to spend another $1 trillion over the next 3 years. I've seen numbers as high as 4 to 5 trillion by 2030. So we have this massive capital expenditure build out of this new technology, new infrastructure for new technology. What we haven't seen yet is there are a few, but we haven't seen a lot of companies actually building businesses on top of that infrastructure. That's what turned the 1990s from an internet boom to like a dot-com mania. It's
Yeah.
when all those companies get built on top of it. And so I think probably for the next 2 to 3 years, we're going to continue down this infrastructure build out. At some point, we're going to start getting massive amount of companies built up on top of this. When that happens, we are going to see, I expect, a dot-com style mania where most of it is built on faulty assumptions, nothing businesses that are getting crazy multiples. You can point to a handful of things in the market today and say this is like that, but I think we're not anywhere near that yet. So I would expect kind of a more kind of normal market over the next 2 or 3 years, and then at some point, whether it lasts 12 months or 24 months or 36 months, it's hard to know. We're going to get that mania type boom. That's where the secular bull market's going to peak. So that could be 2029, it could be 2031, it could be 2032. But it's almost certain to happen, and we're probably going to get a lost decade in stocks after that. So that's kind of what I see. So it is good news for the longish term, but all of these things that seem like they're going to work out forever never do. So there will
Right.
be a reckoning eventually, but I think it's a lot farther off than most people expect.
Yeah, probably so. I mean, I'm thinking as you're talking there, I'm thinking about there's a lot of these private AI companies that are thinking about going public eventually. Maybe that aligns with that next period, what you're talking about. And when you know, you'll know it
Yeah,
when you're in it, right? When everything
yeah,
has
we
.ai at the end of it and is getting a bid
exactly.
up for no
We
good
started to
reason.
see some of that, right, with
Yeah,
CoreWeave going public and that being incredibly successful. But still, like that is an infrastructure company. One that I think of that I've heard recently is Perplexity, which is
yeah,
built on top of OpenAI's technology. So that's literally a product built on top of the infrastructure. That is exactly this thing.
yeah.
I think in the private markets, that's raising at like $15 billion or something, which is a big number, but it's not 1998 anymore. Like we have $4 trillion companies. OpenAI is a 300 or $400 billion company in the private markets. So to see uh, a tiny little company, I mean, 15 billion is tiny these days. That's the thing. So
Yeah.
if we saw these kind of things raising at 200 times sales with a $400 billion valuation, that would be crazy. We're not there yet. We're not even close. It's still a long way off, I think.
All right. Well, that's encouraging for the next couple of years. And the lost decade part that you mentioned there isn't for, we're on the relatively young side here. That wouldn't be very fun. Lost decade, but
I mean, it
I guess
depends how
that
you look
tends
at
to
it, right?
happen, right? Yeah,
You get to buy consistently at lower
that's true.
prices, so that's
Yeah,
good. But if you need the money in the next 10 years, it's less good.
that's right. Yeah, it's all about the
Yeah,
timing. We go back to tariffs for a second. When we were prepping for this, I said, "Hey, maybe I want to talk about tariffs a little bit because people have been writing into the digest." I asked the question like, what are people actually seeing? And we have a lot of small business owners and whatnot in our audience, and a lot of them were saying like these things are killing us. Our profit margins are shrinking, and the uncertainty is more paralyzing than
yeah,
anything. Um, uh, and then we get into like the philosophical discussion about what short term, long term. But you were like, yeah, that's great. I don't know if I'll have too much to say about tariffs, and I think that's the point, right? Like, like why is that your response to like tariffs or whatever it may be, just through the work that you do?
yeah. So I think there's a trend that's been going on for at least the last 15 or 20 years, and that is that when I say stock market, I think S&P 500, right? So the 500 largest companies in the world or in the U.S. Um, there's been a trend that as time has gone on, the S&P 500 has kind of decoupled from the overall U.S. economy, and it's like every year that goes, the S&P is a little less representative of the overall economy. Um, I'm not saying that that's a good thing or a bad thing. It's just a thing that has happened. And I would say in the last 3 years, especially since that bottom in 2022, we've seen this and play out in, I would say, relatively dramatic fashion in that mid cap stocks have done a lot less or a lot worse than large cap stocks, and small cap stocks have done worse than that. So it's kind of this farther down the chain you go regarding size, the less successful the U.S. economy appears to be. So the S&P 500 has done incredibly well. Most things that are smaller have been hurt. At the end of the day, very large companies can handle these things much easier when it comes to tariffs, whether it's uncertainty or the actual costs. In the first quarter, S&P 500 margins were like 13%, which is not quite the all-time high, but pretty darn close. They have a lot of more levers to pull. At the end of the day, they probably have better people with more experience who have gone through more crap throughout the years,
Yeah,
uh, and more access to capital. All of these sorts of things that make this kind of stuff kind of easier to get through. So it's not that I would say that tariffs don't matter. I would say if I'm thinking about investing, especially in large cap stocks, tariffs don't matter. And those are two very different statements.
yeah,
I'm sure for the small business owner, especially in certain industries, it's absolutely brutal and I mean, potentially even business ending, which is terrible.
yeah,
And I definitely feel for that situation. But, you know, you can just make a choice as an investor. I'm just not going to buy small caps or I'm just not going to buy mid caps. I'm not going to fight the tape to a certain extent. I'm not going to
yeah.
go out there and hope that things are going to reverse when there are kind of a big sea change against you, working against you. Instead, you can just go play in the sandbox that's working right now. So that's kind of how I view it as an investor. But that's a different discussion than are do these matter at all? If that
Right,
makes
right,
sense.
right. Yeah, yeah, totally. No, I get what you're saying. Yeah, and you look at small caps. I think they still haven't gotten above. Let me look back at the chart here. They still haven't gotten above like the previous highs of
Yeah, I don't think so.
several years ago. So
Yeah, yeah.
um, yeah,
It's been a super tough period, and I made a couple of recommendations, thinking that that trend's going to buck, and there's a lot of value there, and this and that and the other. But at the end of the day, it's been a mistake on my end to try to do that, because I should take what the market's giving me, and I think that's an important lesson for investors, is that you can always try to you can get mad at the market for not doing what you want it to do, or you can take what it's giving you and move forward from there. So that's a lesson I've learned a handful of times throughout my career, and I'll probably learn it again in the future, but that's okay.
yeah, me too, for sure. What's what's one area maybe we can get into that let's analyze like one area that you're, I don't know, bullish or bearish on like right now. Is there anything that sticks out? What you've been, I know you can't really give away like the recommendations per se here, but
Sure.
is there like a area sector? I know you've written about international stocks in the past as well, and I mean everything. The great thing about your systems is that you can apply it to everything. So anything
Yeah.
stand out to you right now?
Yeah. I mean, I think there's a couple of ways I could go. I think one of the more obvious opportunities right now, that most people probably are just now kind of waking up to, is in precious metals. Um, I've written about gold a lot over the last couple of years. Gold kind of struggled around that $2,000 mark from 2020 through really like late 2023, early 2024. We finally saw that breakout happen, and the market was really only moving by kind of big institutional buyers. Mostly global central banks were buying the crap out of gold in 2021, 22, 23. And that retail has kind of just woken up, now with gold over $3,000 an ounce. Retail is now just kind of waking up to the opportunity there. But I think it'll probably play out. It'll probably take longer to play out and lead to higher prices than most people expect. If you look at a chart of gold now and you see, $1,800 an ounce 3 years ago, and now you see $3,400 or $3,500 an ounce, it feels like you missed it in that regard. I'll say when I started in this business in 2010, I was just enamored. Gold is like the thing that is kind of put into my head. It's like seared into my brain how the gold market was back then.
Yeah.
And that's because like it was definitely the mania phase was underway at that point. Gold was 8 years into what would turn into a 10 or so year bull market. Every advertisement on television was, and this is back when people actually watched financial television,
Right.
was, we buy gold or sell this gold or XYZ.
Yeah.
It was all completely related to the metal. So it was very much a retail mania that was underway at that point. And that went on for another year, and the price went up 50 or 70%, and then it fell for year after year after year and dropped 50 or 60%. And so I think we're at the start of that retail mania type phrase in gold. What's interesting is that for the first time this year, we've seen the gold miners really start to pick up. They had a lot of cost issues.
Everybody's been waiting for the gold miners to take off.
Yeah, I mean, they were absolutely crushed by inflation. I mean, I would say that these are historically some of the worst businesses in the world. I like to say that a successful gold mine is one that can just stay in business for more than 10 years without, going bankrupt. Because it's a difficult business with low margins, and you're a price taker, not a price maker. So you can just go from a really good situation to a really terrible one effectively overnight, and it's completely out of your control. But these companies had massive cost overruns during the inflationary period of 2022 and 2023, and they've really gotten that in order in the last 12 months or so, where costs have moderated and gold prices have gone up a lot. So the leverage factor that you generally get out of miners has finally started to work in their favor, really in the past 12 months. So we've seen a lot of good action there. The other thing,
what's the trends like with the gold miners? I don't know. Is it like in ETFs or
so GDX is the Van Eck Gold Miners Fund, and that's the kind of the broad basket. They also have a junior miner, GDXJ. These things are effectively the same product, though, if you look at how they perform over periods of time. Gotcha. I think the other kind of sleeper opportunity is in silver. Silver has definitely lagged behind gold over the last couple of years, and so we do a ratio. I wrote about this recently, the gold to silver ratio, which is just how many ounces of silver does it take to buy an ounce of gold. Now, this has moved around a lot over history, but essentially, anytime it's hit a multi-year high, silver has gone up, I think on average, about 40% over the next year. So we saw a multi-year high at about 100 earlier this year. Silver has been actually taking off in the past few weeks. I think that's a trend where there's probably a lot more upside. Silver tends to be more retail driven as opposed to institutionally driven. So if we're moving from, I would say, the early stages of a boom, where kind of early on you expect smart money to be buying, institutions to be buying, later on retail comes on, and eventually you get an all-out mania. So I would expect silver to kind of start moving up as we enter that retail phase, which is what we're kind of seeing right now in the data.
Okay. How are you seeing that in the data? Like, how do you gauge whether retail's taken off
So
or not?
the thing we love to use are shares outstanding of
Mm,
ETFs. So this is kind of when I first started, the ETF business was relatively new, and this wasn't really a thing that was that useful. I would say, over the last 5 or 10 years, has become maybe one of the most useful sentiment tools. So you think about what an exchange traded fund is, right? It's just like a very easy way for anyone to buy into in a lot of times, a hyper specific investment idea. So you can buy the S&P 500 ETF. That's not really going to tell you much about what investors are doing, because they're probably just buying it in their 401k, or it doesn't really matter. But if you have a ETF that just tracks the price of gold, well, people only buy that if they want more exposure to the price of gold. So the way ETFs work is, if I go and I try to buy $1 million of GLD, which is the gold ETF, the market maker is going to create those shares, and then they're going to go buy the underlying asset, and so it can sell those shares into the market, or sell those shares to me. So then the share count goes up based on that demand, effectively. If I go to sell that $1 million, they're going to sell the gold and liquidate the shares. So these share counts move up and down over time. Like, this is kind of the defining feature of an exchange traded fund. What that means is, when you have a hyper specific investment idea like gold or like silver or like gold miners, you can look at what that share count's doing over time and get a feel for what regular investors think about this idea. So we saw GLD's shares outstanding falling throughout 2021, 2022, 2023, and most of 2024. So despite gold prices rising, it was very much institutions. It was global central banks that were buying the metal and pushing the
right.
price higher, because retail through GLD, you could see, were selling. I've got a handful of coin dealers that I like to talk to as well, and they said the same thing. There was just no volume. The phones didn't ring for 2 years. They've told me that has started to change this year, and then also we've seen a reversal in shares outstanding for GLD. So it started to go on from I would say, a major downtrend, and it started to become into a pretty major uptrend. One of the things that's exciting about gold stocks as well is that, despite the good rally we've seen over the past 12 months or so, shares outstanding are still falling there. So retail hasn't really got onto that idea in an aggressive way yet. And I would say it's pretty similar for silver.
Okay. Well, I think a lot of people will be happy to hear this. The setups in gold and silver,
Yeah.
um, and stocks, from what you're saying. We're headed, I don't know, it sounds like to you we're in a good place. Um, if we're talking precious metals and stocks, I mean,
Yeah.
that's a pretty good situation, right?
Yeah, I think
Um,
so.
yeah. Is there one indicator that you really like, to kind of gauge market health? Um, it's since you're saying, it's all about the numbers here. Is there a number that that if people, just wondering, some number to trust, what's one that you would say has to be on their list?
Yeah, so I think one of the most important things is something that's called the advance decline line. You can find these on all kinds of different things. The one that I've used historically is the New York Stock Exchange all listed securities advance decline line. So this is a cumulative series. So say on today there are 1,000 things listed on the NYSE that go up, and there are 800 things that went down. Then you take the positives minus the negatives, and you end up with 200 in that case. Tomorrow you do the same thing. You say you get 500 tomorrow, then you add those two together and you get 700. And then the next day you do that and you add that number to 700. And then over time, you build this cumulative series. And it's essentially telling you this is an indicator of what we call market breadth. And what that means is how broad or narrow is the rally that's going on right now. It doesn't matter how well NVIDIA and Microsoft and Amazon and Apple are all doing if every other stock in the market is going down. At the end of the day, those big companies, even if they're doing fantastically, are going to get their comeuppance because a handful of companies can't go up when everything else is going down. You can come up for explanations why that is the case. I don't really care about the explanations. I just know throughout history that's always led to bad things.
Yeah.
So I think market breadth is a really important thing. You want to see more stocks going up than going down. And so the advanced decline line is a really strong way to see that happening. Right now, the advanced decline line is breaking out to new highs, which is exactly what we would want to see.
Right. Yeah. No, I'm glad you brought that up. I had a feeling you would say that, the advanced decline line. And it I mean, yeah, it is breaking out to new all-time highs right
Yeah.
now, which is, for people who think, hey, this might be like this recovery might just be a short-term thing. If you look at number of stocks going up versus down, you would come to a different conclusion that it's
Yeah.
stronger than it might appear.
Yeah, and if that's difficult for people to find, because some things these are relatively esoteric data series to find. Another way you can look at it is just the ticker RSP, which is the equal weight S&P 500 index.
Yeah.
This is, I would say, you're all swinging at the same kind of pitches. These are similar things, but instead of the S&P being market cap weighted, where you have 30 or 35% in these top 7 stocks, now every company is equally weighted. And so if you see the broad market breaking out and you see RSP breaking out, well, that means that most stocks are going up as well. So that's a much simpler way for people to track, I would say, a very similar thing. Unfortunately, the equal weight has not broken out to a new high post what we saw in February, I think. So that's something definitely to keep an eye on. When you see, I would say, a big divergence between the broad market and between these breadth types indicators, that can tell you that there's something. It doesn't guarantee bad news, but it's definitely a yellow flag as an investor that you need to think, like, if this doesn't work itself out, this could lead to problems. We saw that in 1999, where I think the advanced decline line peaked maybe a year before the overall market peaked in 2000.
Yeah.
And it was absolutely collapsing. So the underlying health of the market was terrible, I would say, during the most furious part of the dot-com boom. And that, you can still make money in the short term on the right things, but that tells you that there are problems brewing underneath the surface.
Yeah, for sure. I think something similar happened in the end of 2021.
Yes.
Right before interest rates went up. And I think, you saw all those crazy, the tech stocks and whatnot peak at the beginning of 2021. But
yeah, people forget that entirely. But I would say all of the exciting stuff, the Pelotons of the world, they peaked in February of 21, and the overall market peaked in November or December, maybe even in early January of 22. But that was definitely something that told you that this mania that is going on is kind of unraveling, even though the big stocks are. I mean, it was a warning sign for sure.
Yeah. All right. That's a great one. Yeah. The advanced decline line, to me, it's helpful, like you said, like a yellow flag, or just kind of for turning points. Like if you're looking for some great context, like it'll it'll do that. I mean, the first time I heard somebody explain it to me, like, it's just measuring the number of stocks going up versus down. I was like, is this really, this is it? This is what we're doing? But it makes total sense.
Yeah. To me, it's just like, there's a lot of times when it's so easy, I think in a moment like this as well, where it's hard to objectively say that we are on more firm footing today than we were 6 months ago. However, the market is at higher places than it was 6 months ago. And that I think for a lot of people, they think about something like that and it feels very unsettling. And so to me, when I see the market breaking out, I look at the advanced decline line or look at those kind of indicators, and it's just like, you can breathe a sigh of relief. Like, I want to think that this is problematic, but the market is telling me that it's not. And so that to me is what it is. You very rarely see the big divergences. What it can do is kind of walk you away from the edge if you're thinking that horrible things are about to happen because you've gotten yourself worked up about X or Y or Z.
Yeah, for sure. No, it's definitely you're preaching to the choir there. I figured that out at some point, so that was good. Um, all right, let's briefly switch gears to. We just had Alan Gula, on a couple weeks ago,
Mhm.
talking about our portfolio solutions products, and you are also a key member of that team. So, how do you translate what you do in True Wealth and all of those franchises into what you do with portfolio solutions?
Yeah, well, it's funny. I started working on portfolio solutions maybe 3 years ago, and I was surprised how different it was versus what I do in True Wealth and True Wealth Systems. And that is what we do in portfolio solutions is really design. It's a complete portfolio designed from the ground up. And when you take that approach, you have to think very differently. If you look at the True Wealth or True Wealth Systems portfolio at any time, what we tend to do is pile into a lot of the same ideas because those are the things that are working over a period of time. And so, like right now, you'll see a ton of foreign stock recommendations in True Wealth Systems and a lot in True Wealth as well. And then a lot of metals and mining and things like that because those are the things that are working. Those are where we see the biggest opportunity. If we tried to do that in portfolio solutions, you would just end up with something where you had to do way more trading than you would want to in the context of a portfolio. So we really design it from the ground up with the idea of like, what are all the big themes that we think are going to be important and what they're going to drive the market? How do we want to tilt what we're doing against the broad market so that we can hopefully generate that alpha in a portfolio context? And then it's not finding, and a lot of times, if I'm excited about gold stocks, I might just recommend GDX and get the broad basket. But in portfolio solutions, we're always trying to think like, what are the one or two companies that are the absolute best in this industry at all times? To not just get the broad theme built in, but to get the best companies of that broad theme. So it really is a very different kind of way to approach it. The other thing I would say is that I've pretty religiously recommended stop losses in True Wealth and True Wealth Systems over the years.
Mm-hmm.
And I think in the context of that product, that makes a lot of sense. When you're building a portfolio, you can do things a lot differently when it comes to stops and risk management. The first time I heard this, I thought it was silly, and I think over time it's become, I think it's brilliant. And it's if you're worried about how much stocks you own, then you don't need to come up with some complicated hedging strategy or derivatives or this and that. You can just own less stocks
Right.
because now you have less risk in the stocks that you own. You just own less of them. And
Right.
we don't think about that in True Wealth in a newsletter format, but in a portfolio format, it's brilliant. If you think that this is a risky position, then you just buy 2% instead of buying 4%. And now you've dramatically reduced the risk of that position to your overall portfolio. So the way we do risk management and utilize stops and things like that is drastically different. But the numbers have been really, really good this year. I don't have them exactly offhand, but I think the total portfolio is up something like 15%, while the market's up 5, something to that effect. And we had a much smaller drawdown during the April sell-off, and
Right.
so the solution works really well. And I'll give a ton of kudos to Alan. He's the architect in many ways, whereas I just kind of help in and step around and nibble around the edges to help out. But he definitely gets the majority of the credit in that. But it's been a lot of fun to do, and I think it's a different thing for readers that for certain people is really, really useful. One of the things I've heard over the years at conferences is I get all these products and I just don't know what to do with them all. I got all these great ideas and I don't know how to utilize them. And I definitely understand that difficulty for people. So that was what we tried to fix in portfolio solutions. And I'm glad to see that it's working well.
Yeah, no, that's great. That's interesting to hear about, you're identifying more like the best possible plays on those themes or individual stocks, and that's what you kind of can do. And Alan talked about this, like that's what you can do when you have somebody who's actually doing this for you,
Yeah.
because it's pretty hard to do it on your. It can be hard to do it on your own unless you're doing it full time. And so, yeah, I just wanted to make sure we mentioned that you're also part of that group. So, um, cool. All right, I do want to ask you about real estate briefly as well, before we go. I know last time you were here, you said you actually, most of your like personal investments would be real estate related. And you mentioned it before, the market the last couple of years, um, not so great. What's your take on real estate right now? I'm in the middle of selling our current place where I'm living and buying a new one, actually, finally. And
I'm sorry to hear that.
what's that?
I'm sorry to hear that.
Yeah, well, it's needed, but
Yeah.
I don't want to give up my 3%
Yeah.
interest rate, but it's happening. So, what's your take on the real estate market right now?
Yeah. So, I mean, it's obviously two very different things. That's like the commercial market and then the kind of residential market.
Right. Yeah.
Um, I think I'm sure there are people that will disagree with this, but I think if the U.S. Kind of housing market was going to die, it would have died a long time ago. We're essentially 3 years into mortgage rates being twice what they were for the decade prior. We've had 6 to 7% rates for a solid 3 years now, and home prices haven't budged at all. And I think that tells you just how out of balance the inventory versus the number of buyers really were. That's what led to the crazy boom in 2020 and 2021. And we've seen a handful of markets that really, really went crazy start to roll over a little bit. But I think on the whole, we just still have too many buyers for the number of homes that are for sale. The other thing is that as time goes on, there are going to be more people like you who, man, I'm sure 3 years ago, there was no way you were getting up with that 3% mortgage. And 2 years ago, there was pretty much no way. And a year ago, man, it had to be the perfect house.
Yep.
And now you're giving it up, right? As time goes on, people just settle into the new normal. And as much as no one likes it, 6 to 7% mortgage rates are the new normal. And so people are going to continue to live their lives based on that new normal because they don't have an option. You can't just wait around forever. People will wait around for a while, but 3 years in, you can't wait around forever.
Yes, my kids are not getting smaller. So
exactly. Yeah, that's exactly it. And so I think if we're going to see like a lot of destruction in the U.S. Residential market, it probably would have already happened by now. We've actually started to see activity pick up. Mortgage applications hit I think 2.5-year high last week in the most recent data. So we're still well below what I would call a normal market, but we are on the path to normalization around that much higher mortgage rate. That just kind of is what it is. When it comes to the commercial market, I think that there's been, for better or worse, essentially just activity has gone to zero. I mean, that's true in residential as well, but there could have been a lot of, if people were forced to sell throughout 2022 and 2023, we would have seen a lot of absolutely brutal price destruction. And nobody sold unless they absolutely had to. And I think we're starting to see prices tick back up. We're going to see activity tick back up. I think even in the office space, things are getting better. I recommended BXP Holdings in True Wealth recently, it used to be called Boston Property, which is the largest U.S. Office REIT. And at the end of the day, like this company has seen their funds from operations grow every quarter for the last 3 years throughout this terrible situation. So the office environment is much different than it was in 2019, but it's also much different than it was in 2022. People are going back to the office. Big companies are forcing people back to the office. This has kind of gone through fits and starts, I would say, over the last 2 or 3 years, but we're having another push right now with getting people back to the office. And so I think office is obviously the most beaten up portion of the commercial real estate market, but banks have been willing to kick the can down the road. No one's selling unless they have to, and we're starting to see some rebound. So I'm not sure we're going to be in a boom time, like boom time anytime in the next 2 or 3 years, unless we see rates come down a lot. I think that'll be the catalyst. Mm-hmm. But again, that's a market where if it was going to die like people anticipated in 2022, it would have already, and it just hasn't gotten there yet.
All right, yeah, we're past that. We're past the worst case.
Hopefully,
scenario. Yeah, hopefully. Yeah, it'd be interesting to see what happens with interest rates as we're right before we recorded this. I saw the report that Trump has said he wants to fire Powell, the Fed chair, soon now, and he's going to do it soon, is what he told some people in Congress. So we'll see if that happens. What's that?
His term only goes till February, March. Is that right?
May of next year. So one way or another, it's you know, it's happening. It's just a matter of timing at this point. But yeah, anyway, it will be interesting to see what happens with rates, and I will be personally curious myself, if it happens sooner than later.
Get that refi in.
Yeah, gotta get that. All right. Well, this has been great. I think we can see, I got a great insight as usual from you into all different kinds of things. And so we've reached our final question, which Dan always asks, but I'm going to do it this time, and it feels strange me asking it, but here we go. So same for every guest, no matter the topic, even if it's a non-financial topic. And you can repeat it if it came up before. But if you could leave our listeners with a single thought, what would it be?
Oh man, a single thought. I feel like every time Dan has asked me this question, I half remember what he asked me last time, and then I forget, and then I have this panic moment, like, what is my single thought? Maybe I've given this kind of answer in the past when having this discussion with Dan, but I would say when it comes to investing, and I think this is important as we have moved through this tariff moment, in my mind, move through it, it's always remember that the worst case scenario almost never plays out, and just worry less, think about things less. I would say one of the things I picked up from Steve early on in my career is that if there's 1,000 headlines going by every day, one or two of them maybe matter. Really, your job as an investor is to find the 5% of things that actually matter and focus on those and ignore the rest. And then once you do that, you can just worry about things a lot less. So yeah, I mean, I would say try to get your stress level down when it comes to the world of investing. The world hasn't ended yet. It's probably not going to anytime soon. Things are going to be fine. Stress less.
I like it. Yes. If the world's ending, then we're all, you don't have to worry about it.
Yeah. Who cares about your portfolio?
All right, cool. Well, thanks for being here. We'll have you again soon, and maybe Dan will be back from vacation.
Sounds great. Thanks, Corey. I appreciate the time. It's fun.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.